War is not merely a series of explosions. It is a force that reshapes economies. Not instantly, not visibly, but structurally. Today, a conflict rooted in geopolitical tension in the Middle East is redefining global energy markets, financial stability, and power distribution. In early 2026, joint military action by the United States and Israel against Iran triggered a dramatic escalation in the region. Oil tankers were rerouted, major airports faced attacks, flight cancellations climbed, and the flow of crude through the Strait of Hormuz, the artery of global oil, slowed dramatically. Content reference, OASite. 1. Index equals 1. The Strait of Hormuz is not a distant abstraction. Roughly 1/5 of the world's crude oil and liquefied natural gas transit this narrow channel to supply Asia, Europe, and North America. Content reference, OASite. 2. Index equals 2. When shipping is disrupted, prices surge, confidence falters, and inflationary pressure rises. For consumers at the pump, for industries reliant on energy, for governments balancing budgets and debt. This is where war and economics intersect. To understand this intersection, we begin with the basics. Energy is the lifeblood of modern economies. It fuels production, it fuels transportation, it fuels industry. When energy becomes uncertain, economic growth becomes uncertain. And when uncertainty rises, markets react. In early March 2026, global oil prices spiked nearly 10% on fears of enduring disruption to supply. Content reference, OASite. 3. Index equals 3. Not just crude, natural gas futures climbed as well. Defense and safe haven assets surged. Stocks wavered. When fear enters markets, capital flows away from risk. This is not a speculative notion. It is observable in real time. And the primary driver of this fear was not a distant war in a distant land. It was the blockage or potential closure of the Strait of Hormuz. When a choke point handles 20% of global energy shipments, any disruption has outsized effects. Content reference, OASite. 4. Index equals 4. Let's break this down. A country like Japan, heavily dependent on Middle Eastern energy imports, must consider alternative supplies when its primary route becomes unsafe. Content reference, OASite. 5. Index equals 5. India, too, may turn to other suppliers if the crisis drags on. Content reference, OASite. 6. Index equals 6. In the short term, this increases shipping costs. In the medium term, it squeezes inflation. In the long term, it reshapes trade patterns. But war does more than disrupt energy. It drains resources. Economic research on conflict zones repeatedly shows sustained conflict weakens GDP, reduces investment, and increases structural fragility. Content reference, OASite. 7. Index equals 7. Iran's economy, already facing deep contraction before the latest escalation, now confronts further strain from sanctions, oil export declines, and reconstruction costs. Content reference, OASite. 8. Index equals 8. Meanwhile, global markets respond to shifting expectations. Debt markets, interest rates, sovereign credit, corporate borrowing, all these variables adjust when uncertainty rises. Central banks may intervene to calm markets. Liquidity becomes essential, confidence becomes currency, inflation expectations shift, policy changes, bond yields adjust. This is not happenstance, it is structural. War introduces risk, risk changes incentives, and incentives shape economic architecture. Let us consider historical parallels. World War I triggered disruptions to trade networks. Energy prices surged, supply chains fractured, and nations restructured their fiscal priorities. World War II saw similar patterns at a larger scale. But the modern global economy is far more interconnected. Information travels instantly, capital flows instantly. A shock in the Strait of Hormuz reverberates in Tokyo. It echoes in London. It affects Buenos Aires, New York, and Berlin. When markets sense instability, capital allocates differently. Safe havens gain capital, equities retract, currencies fluctuate. The US dollar often strengthens in times of geopolitical tension, not because of glory, but because of liquidity preference. When risk rises, dollars are demanded. Safe assets become anchors. Gold often rises alongside uncertainty. Bond markets adjust based on expectations. And this is critical. Fiscal balances change the moment risk premiums increase. Governments that borrow in foreign currency feel pressure. Rates rise. Servicing costs climb. Inflation complicates central bank mandates. Stability becomes the priority, not growth. This is a key insight. War steers policy toward risk aversion, not optimism. Now let's turn to a concrete mechanism. Consider how energy price spikes influence ordinary life. Higher oil prices push up transportation costs. Food production becomes more expensive. Goods become pricier. Inflation spreads. Inflation, in turn, pressures central banks. Rate decisions become harder. Tighten to control inflation? Risk recession? Loosen to support growth? Fuel inflation further. These decisions are structural. They shape decades of economic performance. Modern geopolitics intersects with finance through these mechanisms. But war has deeper effects. Public debt expands. Defense spending rises. Healthcare demands increase. Reconstruction consumes capital. In nations involved directly in conflict, internal borrowing increases debt burdens. In nations affected indirectly, fiscal priorities shift to mitigate risk. This is why modern war has global economic implications. And this is why conflicts like these can alter growth trajectories for years. Now consider market psychology. Investors do not simply look at current data. They look at expectations. If war escalates, future cash flows become riskier. Discount rates rise. Valuations adjust downward. This explains why stock markets can fall even as defense stocks rise. Risk is repriced. Sentiment shifts. Confidence, that intangible element, weakens. War does not just change numbers. It changes belief. Belief affects spending, investment decisions, borrowing capacity, and ultimately growth. Now let us return to Iran. Iran's economy was already under stress before this escalation due to sanctions and structural inefficiencies. Content reference, OASite. 9, index equals 9. In 2025, the country faced deep inflation and rising poverty, a prolonged economic crisis even before the current conflict. Content reference, OASite. 10, index equals 10. Oil exports, central to Tehran's fiscal position, have been vulnerable due to sanctions and wartime damage to infrastructure. Content reference, OASite. 11, index equals 11. Now, disruptions in export channels further strain fiscal balances. Domestic consumption falls, private investment retracts, unemployment rises, and social discontent becomes economic friction. Meanwhile, global supply chain disruptions reverberate outward. Higher energy costs increase production expenses. Shipping labor reallocates. Trade flows restructure. Even industries such as textiles and luxury goods feel impact due to rising cost of raw materials. Content reference, OASite. 12, index equals 12. In emerging markets, higher energy costs make debt servicing harder. Fiscal balances deteriorate. Borrowing becomes costlier. Global South economies feel a web of dependencies. Now, consider developed economies. Higher oil prices push inflation. Central banks face policy dilemmas. Consumers face higher living costs. Mortgage rates linger high. Discretionary spending contracts. Consumer confidence weakens. This is not hypothetical. This is visible in market signals. Indices dip. Safe havens rise. Yield curves adjust. This is how war reshapes financial structure. But here is the paradox. Stability measures often increase integration. Emergency liquidity facilities, central bank cooperation, policy coordination, systems knit together more tightly during uncertainty. Risk is shared. Fragmentation often weakens as networks tighten. This is the invisible network reacting. War does not break systems instantly. It reveals structural dependencies, sometimes vulnerability, sometimes resilience, and history shows that after shock comes reordering. Trade routes change, investment patterns adjust, currency preferences shift, economic alliances evolve. This is the long-run impact of conflict. Not merely destruction, but transformation. Understanding this transformation requires seeing war as a macroeconomic force. Not a headline, not a moment, but a process. A process that changes incentives, shapes markets, reconfigures power. And when power reconfigures, so does wealth. This is why modern war matters. Not only to soldiers or states, but to every economy, every market, and every individual. Because the ripple effects spread far beyond borders. And because history knows that economic structure rarely returns to its prior state once altered. This is the economic legacy of geopolitical upheaval. Not immediate collapse, but enduring shift. And that is why we must study it. Not to fear, but to understand.